Standard Chartered just did something that no globally systemically important bank has done before, and it happened the same week the bank reported its best quarterly earnings in years, yet the stock sits nearly 4% below its 12-month high. That gap is the question this video investigates. On April 28th, Standard Chartered, BlackRock, and OKX announced a joint framework allowing institutional clients to post BlackRock's BUIDL Tokenized Treasury Fund as collateral while trading on OKX Middle East. Standard Chartered acts as custodian, holding the collateral off exchange in regulated custody, segregated entirely from OKX's own assets. 2 days later, the bank reported Q1 profit before tax of $2.5 billion against a consensus expectation of $2.1 billion and earnings per share of 72 cents against a consensus of 54 cents, a 33% earnings surprise. These two events are not coincidental in timing. They are signals of the same strategic pivot. The tension is that markets have not priced both together.
To understand why the custodian role matters, the G-SIB designation needs unpacking, because this is the detail most commentary has skipped over. A G-SIB, a globally systemically important bank, operates under the most stringent regulatory capital and oversight requirements in the financial system. When Standard Chartered steps into a tokenized collateral framework as custodian, it brings regulatory credibility that no crypto-native firm and no smaller institution can replicate. The collateral sits inside a regulated custody structure, backed by the same supervisory regime that governs the largest banks on Earth. That is a fundamentally different risk profile than any prior off-exchange collateral arrangement in digital assets. For institutional clients, pension funds, sovereign wealth funds, large family offices, that regulatory backstop is not a minor feature. It is often the threshold condition for participation in crypto-adjacent markets at all. Many of these institutions cannot post collateral on an exchange that lacks this layer. The framework effectively opens a door that was structurally closed before. BUIDL, BlackRock's tokenized short-term U.S. Treasury Fund, is tokenized by Securitize. The innovation here is that the collateral yields while it sits. Idle margin earns Treasury returns rather than generating zero. That means an institutional client posting BUIDL as collateral is not sacrificing return for access. Capital is simultaneously productive and deployable. That combination did not exist in this form before this framework. Standard Chartered is also exploring a partial acquisition of Zodiac Custody, a crypto custody firm. A Hong Kong joint venture with HSBC received the city's first stablecoin license. The BUIDL framework is not a standalone experiment. It is one node in a custody and digital asset infrastructure being assembled in parallel.
The Q1 earnings result matters here not as a standalone number, but because of which revenue line drove the beat, and that line reveals something about the strategic direction. Non-interest income rose 16% and was the primary driver of the earnings outperformance. Net interest income was broadly flat. This is a structural shift. A bank whose earnings beat comes from non-interest income is less exposed to central bank rate decisions and more reliant on fee-based, volume-based, and transaction-based revenue. Wealth Solutions income, up 32% in a single quarter, is the clearest illustration. Clients are moving capital through Standard Chartered's platform, not just parking deposits. Global banking income rose 19%, consistent with the infrastructure financing activity visible elsewhere. Standard Chartered arranged $2.33 billion in funding for a Tanzania railway project. It is backing UK solar and energy storage. These are not peripheral. They represent fee income from capital-intensive mandates that don't depend on rate cycles. The ROTE reading of 17.4% in Q1 against a full-year target of greater than 12% creates its own tension. Either Q1 was an anomaly that reverts toward the annual floor, or the full-year guidance is conservatively anchored and Q1 is closer to a run rate. The bank left full-year income growth guidance at the bottom end of 5 to 7%. That phrasing, bottom end, is a known hedge against macro uncertainty, particularly given $190 million in impairment charges from Middle East conflict exposure. The $296 million in total impairment charges is the threshold to watch. If Middle East conditions deteriorate further, that number scales. If they stabilize, impairment normalizes, and the underlying ROTE story becomes the dominant narrative again.
The framing most coverage applied to the BUIDL framework was infrastructural. Standard Chartered is providing a service to institutional clients of OKX. That framing understates what is actually being built. Custody is becoming a revenue-generating asset class in digital finance. As tokenized real-world assets scale and the BlackRock partnership signals institutional conviction that they will, the custodian sitting at the center of those flows captures fees at every settlement, every collateral movement, every yield distribution. Standard Chartered is not providing a one-time service. It is positioning inside the transaction infrastructure of the tokenized asset market at the moment that market is acquiring its first credible institutional participants. CEO Bill Winters purchased 86,027 shares at GBX 1507 in March 2026. The current price is approximately GBX 1854. That insider purchase, made before both the BUIDL announcement and the Q1 print, is a data point, not a guarantee, but a directional signal from someone with full visibility into both. The analyst spread tells a different story depending on which number is used. Jefferies targets GBX 2250, JP Morgan GBX 2170, Deutsche Bank GBX 1900, Citigroup GBX 1775. Shore Capital has moved to sell. The consensus average of GBX 1890 sits just above the current price. The range itself is wide enough to indicate that analysts are not converging on a shared model. They are applying different assumptions about which revenue streams accelerate and which revert. The stock's PE ratio of roughly 9.7 to 10 times is the valuation anchor. For a bank generating a 17.4% ROTE in Q1 and operating at the frontier of tokenized asset infrastructure, that multiple reflects considerable skepticism about durability. The market is pricing a reversion, not a continuation.
The forward picture depends on a small number of conditions, each of which is resolvable, but none of which is resolved yet. Evidence leans toward the tokenized collateral franchise becoming a material revenue contributor, but only if institutional adoption of BUDL-style tokenized treasuries accelerates beyond the OKX Middle East pilot. The framework is built. The question is whether additional exchanges, custodians, and asset classes follow. If they do, Standard Chartered's first-mover custody position compounds in value. If the OKX arrangement remains isolated for 2 or 3 quarters, the market will treat it as a proof of concept rather than a business line. On the earnings trajectory, the leaning is that Q1's non-interest income strength is not fully anomalous. Wealth Solutions at 32% growth reflects a structural trend in Asian and Middle Eastern wealth accumulation that does not reverse on a single quarter's data. But the full-year guidance conservatism is a meaning signal. Management is not prepared to commit to Q1's pace as a run rate. The condition that would change that framing is a Q2 print where non-interest income holds above the Q1 level without a corresponding spike in impairments. The downside path is clearer than it might appear. If Middle East conflict exposure generates impairment charges above the $296 million Q1 level, if the BUDL framework draws regulatory scrutiny from any of Standard Chartered's primary supervisors, or if the full-year ROTE converges toward the 12% floor rather than the 17.4% Q1 reading, each of those individually is manageable. In combination, they compress the multiple further. The recovery path runs through the same custody infrastructure. A bank that owns the regulated custody layer for tokenized real-world assets, operates across Asia, Africa, and the Middle East without domestic UK REIT exposure, and is posting non-interest income growth in the mid-teens, has a differentiated earnings profile from almost every other bank in the FTSE 100. The price gap between GBX 854 and the upper-end analyst targets closes only when one of two things happens. The tokenized collateral franchise generates reported fee income that can be modeled, or Q2 earnings confirm that Q1 was not a seasonal outlier. Until one of those two conditions is met, the stock will likely trade in a range bounded by the conservative analysts on one side and the insider purchase price on the other, a holding pattern waiting for the next data point to break the tie.